There is a single question that separates the master investor from the frantic gambler. It is a question so simple yet so profound that it acts as a mental firewall, protecting your life savings from the twin demons of fear and greed. It is not a complex financial formula. It does not require a supercomputer or a degree in advanced mathematics. It is a thought experiment, a mental model that Warren Buffett has used to build a fortress of wealth that has withstood every market crash, every panic, every recession for more than half a century. The question is this: would I be happy to own this business if the stock market closed for the next 10 years? Think about that. No ticker to watch. No daily price quotes to celebrate or mourn. No ability to sell. No temptation to trade. Just you and your ownership stake in an actual, operating business. Could you sleep at night? Would you feel secure? Or would a cold knot of dread form in your stomach? Your answer to that question is the final promise. It is the promise you make to yourself to graduate from the chaotic casino of speculation and enter the serene world of true ownership. It is the promise that you will no longer buy flickering symbols on a screen, hoping to flip them to a greater fool. Instead, you will purchase pieces of durable, high-quality businesses, creating a portfolio so resilient, so fundamentally sound, that you can turn off the noise, ignore the hysteria, and allow the unstoppable force of compound growth to build your financial freedom. This is not just another investment strategy. This is a complete transformation of your relationship with money and markets. This is the mental model for a crash-proof portfolio. Let's begin by drawing a line in the sand. On one side stands the investor, on the other, the speculator. They may both operate in the same market, buy the same stocks, and use the same brokerage apps, but they are playing entirely different games. The speculator's world is a frantic, high-stakes poker match. Their eyes are glued to the price, the ticker, the daily gyrations of the market. They are driven by tips, by momentum, by the whispered hope of a quick profit. They buy a stock not because they understand the underlying business, but because they believe the price will go up next week or next month. Their success depends on correctly predicting the unpredictable emotions of a crowd. The investor, by contrast, is a farmer. They are not concerned with the daily weather report, but with the quality of their soil and the health of their crops. They buy a stock because they see it for what it is, a fractional ownership of a real business. They are concerned with earnings, with profit margins, with competitive advantages, and with the long-term prospects of the enterprise. The 10-year test is the simple, powerful tool that forces you to abandon the poker table and step into the farmer's field. It is the dividing line between gambling and owning, and no story illustrates this philosophical shift better than one of Warren Buffett's earliest and most transformative acquisitions, the tale of See's Candies. The year was 1972. Warren Buffett and his partner, Charlie Munger, were running a burgeoning Berkshire Hathaway, which at the time was still a struggling textile mill with a growing investment portfolio. They were presented with an opportunity to buy a well-known, family-owned chocolate company based in California, See's Candies. This wasn't a stock purchase. They weren't buying a few thousand shares on the New York Stock Exchange. They were in negotiations with the See family to buy the entire company, lock, stock, and barrel. The price they were asked for was $30 million. At the time, the business had about $8 million in tangible assets, things like factories, delivery trucks, and inventory. This meant they were being asked to pay a $22 million premium for the intangible assets, for the brand name, for the customer loyalty, something that was then called goodwill. For Buffett, who had built his early fortune as a disciple of Benjamin Graham buying cigar butt stocks, beaten-down companies trading for less than the value of their assets, this was a huge mental leap. Paying more than 3 times the value of the physical assets seemed, on the surface, like a violation of his core principles. His instinct was to walk away. But Charlie Munger pushed him. Munger saw something deeper. He saw that See's Candies was not just a collection of factories and stores, It was a powerful idea that lived in the minds of millions of customers. In California, giving a box of See's candies was a social ritual. It was the go-to gift for Valentine's Day, for Christmas, for a birthday. The brand was synonymous with quality and tradition. Customers didn't just buy the chocolate. They bought the feeling of nostalgia and affection associated with the iconic black and white box. This gave See's an extraordinary power, pricing power. The company could raise its prices year after year to account for inflation, and customers would happily pay it. They weren't going to risk disappointing their mother-in-law by showing up with a generic, cheaper box of chocolates. The brand was a moat, a deep and wide defensive barrier around the business. Here is the crucial part. There was no stock ticker for See's candies. Buffett and Munger couldn't check the price every day. They couldn't get a quote on its value from the market. They were forced to evaluate it purely and solely as a business they would own in its entirety for the foreseeable future. They were applying the 10-year test without even calling it that. They had to ask themselves, is this a business we want to be married to for a decade or more? Does it have an enduring characteristic that will allow it to prosper through recessions, fads, and changing tastes? The answer, they realized, was a resounding yes. They paid the $30 million. In the years that followed, See's candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It became what Buffett called the prototype, the model for every major acquisition they would make thereafter, from Coca-Cola to Apple. The lesson from See's was profound, and it forever changed their investment strategy. They learned that it was far better to buy a wonderful business at a fair price than a fair business at a wonderful price. They stopped being stock pickers and became business buyers. The 10-year test was encoded into their DNA because they had lived it. They had bought a business, not a stock, and it had made them fantastically wealthy. The reason this mental model is so critical is because it directly counters two powerful psychological biases that lead most people to financial ruin: myopic loss aversion and hyperbolic discounting. These are not character flaws. They are deeply ingrained features of the human brain, leftovers from a time when short-term survival was all that mattered. Understanding them is the first step to overriding them. Myopic loss aversion is a concept pioneered by Nobel laureate Daniel Kahneman. It describes a simple but devastating tendency. We feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. If you find a $100 bill on the street, you feel good. If you lose a $100 bill from your wallet, you feel absolutely terrible. This asymmetry is then magnified by myopia, or short-sightedness. The more frequently we check on our investments, the more likely we are to see them in the red, even if just for a day. Each time we see that red arrow, we experience a disproportionate jolt of psychological pain. This constant exposure to short-term volatility makes us miserable and leads to terrible decision-making. We become obsessed with avoiding the small, temporary pain of a down day, and in doing so, we often sell a great long-term investment at the worst possible time. The speculator who checks their portfolio 20 times a day is a walking victim of myopic loss aversion. They are bathing their brain in cortisol and making it almost impossible to think clearly about the long-term fundamentals of the businesses they supposedly own. Then there's hyperbolic discounting. This is our brain's tendency to prefer smaller, immediate rewards over larger, later rewards. It's why so many people struggle to save for retirement, but have no problem buying a lottery ticket. The small chance of an immediate, huge payoff feels more compelling than the near certainty of a comfortable future decades from now. In investing, this bias manifests as the siren song of the quick flip. The speculator buys a hot tech stock not because they believe it will be dominating its industry in 2035, but because they hope it will jump 20% in the next 2 weeks. The immediate gratification of that small win is more alluring to the primitive brain than the life-changing wealth that comes from decades of patient compounding. The 10-year test acts as a powerful antidote to both of these biases. By forcing you to imagine a world where you cannot sell for a decade, it shatters the myopia. You are no longer concerned with tomorrow's price but with the business's earnings power a decade from now. It makes the daily pain of volatility irrelevant. You're not selling anyway, so why would the price matter? It's just noise. Simultaneously, it crushes hyperbolic discounting. The fantasy of the quick flip is taken off the table. The question is no longer, can I make a quick buck? But rather, will this business generate substantial and growing profits for me, its owner, over the next 10 years? The focus shifts from the immediate, speculative reward to the larger, more certain, long-term reward. It rewires your brain to prioritize the patient accumulation of wealth over the frantic chase for fast money. So how can you, as a retail investor or an entrepreneur looking to allocate capital, apply this powerful mental model in a practical way? You need to adopt what I call the business owner blueprint. This is a tangible exercise that transforms you from a passive stock watcher into an active business analyst. It consists of 4 simple steps. Step 1. Take a piece of paper and write down the ticker symbol of a company you are considering investing in. Let's say it's AAPL for Apple. Now, for step 2, I want you to physically cross it out, erase it. On the line below, write the full company name, Apple Incorporated. Now, go further. Imagine you are not buying a share of stock. Imagine you have saved up enough money to buy the local Apple store in your city's mall. You are becoming the owner of a small piece of the Apple empire. This simple act of reframing is profoundly important. It shifts your focus from the abstract ticker to the tangible business. Step 3 is the most critical. You must now write a 1-page memo to yourself. The memo should be titled, "Why I Am Buying This Business." In this memo, you are forbidden from talking about the stock price, the analyst ratings, or the market sentiment. You must only talk about the business itself. Why will people still be buying iPhones and MacBooks in 10 years? What is the power of their ecosystem with the App Store and iCloud? How strong is their balance sheet? What are their profit margins? You must articulate in your own words the fundamental long-term case for owning this enterprise. You should be able to explain it so simply that a teenager could understand it. If you can't, you don't understand it well enough to invest. Finally, step 4. Before you are allowed to click the buy button on your brokerage account, you must take this memo, fold it up, and place it in a drawer. And you must make a pact with yourself. You will not look at the stock price for at least 3 months after your purchase. This is a training exercise. It forces you to disconnect from the short-term noise and anchor your decision in your long-term business analysis. It builds the mental muscle required for true long-term investing, a muscle that atrophies with every compulsive check of your portfolio. To truly appreciate the wisdom of this approach, we must look at its opposite. We must examine the path of the 99%, the path of the speculator. There is no more vivid example of this than the dot-com bubble of the late 1990s. It was an era of mass delusion, a nationwide fever dream, where the old rules of business were declared obsolete. The dominant narrative was that a new economy had arrived, and traditional metrics like profits and revenue were relics of a bygone era. All that mattered were eyeballs, clicks, and mindshare. Companies with no products, no profits, and in some cases, no coherent business plan, were achieving billion-dollar valuations overnight. A company like Pets.com, famous for its sock puppet mascot, raised $82 million in its initial public offering in February of 2000. It spent millions on Super Bowl ads, yet its business model was fundamentally flawed. They were selling bags of dog food for less than it cost them to acquire and ship. It was a race to the bottom, funded by speculative capital. People were not buying Pets.com stock because they believed in the long-term viability of shipping heavy, low-margin products across the country. They were buying it for one reason only. They believed the stock price would go up. They were buying the ticker, not the business. If anyone had applied the 10-year test to Pets.com, the absurdity would have been immediately obvious. Would I be happy to own this money-losing dog food delivery service if the market closed for 10 years? The question is laughable. The answer is a clear and resounding no, yet millions of people, caught in the mania, poured their savings into it, and countless other .coms. When the bubble burst, the devastation was total. Pets.com went bankrupt just 9 months after its IPO. Trillions of dollars of speculative wealth vanished. People who were planning their retirements saw their savings evaporate. The path of the 99% is paved with these stories. It is the path of chasing narratives instead of value, of buying hope instead of earnings. It is the direct result of failing to ask that one simple clarifying question. The financial consequences of this philosophical divide are not small, they are monumental. They represent the difference between a future of financial security and one of perpetual anxiety. Let's look at the numbers. The speculator, who churns their portfolio buying and selling based on news and momentum, faces several hidden destroyers of wealth. First, taxes. In the United States, gains on investments held for less than a year are taxed as ordinary income at a much higher rate than long-term capital gains. Every quick flip for a profit comes with a significant tax bill that eats into your returns. Second, transaction costs. While many brokers now offer zero-commission trades, there are still bid-ask spreads and other hidden costs that add up over hundreds of trades. It's a small leak, but over time it can sink a ship. But the most devastating cost is the mathematical trap of volatility. Let's say a speculator has a $100,000 portfolio. In a speculative frenzy, they double their money to $200,000. They feel like a genius. But then the market turns, and their speculative bets lose 50% of their value. They are back to $100,000, right where they started. A 50% loss wipes out a 100% gain. Now, to get back to their peak, they don't just need a 50% gain. They need a 100% gain just to break even. This is the brutal asymmetry of loss. The speculator is constantly climbing a mountain only to fall off a cliff, forced to start the climb all over again. The investor, guided by the 10-year test, avoids this entirely. Their portfolio turnover is low, minimizing taxes and costs. But more importantly, by owning high-quality, resilient businesses, they are far less likely to suffer a catastrophic 50% loss in the first place. Their journey is a slow, steady, and relentless climb. While the speculator is experiencing the gut-wrenching volatility of a roller coaster, the investor is riding a powerful, ever-rising escalator, powered by the uninterrupted magic of compound interest. The 10-year test isn't just a defensive shield, it's the mechanism that keeps you on that escalator, ensuring your wealth compounds on top of itself, year after year, decade after decade. It is the blueprint for building not just a portfolio, but a legacy. The 10-year test is a powerful filter, but it immediately begs the next question: what, precisely, is the anatomy of a business that can pass such a rigorous examination? What are the specific traits and characteristics that allow a company to not just survive, but thrive over a decade in which you cannot sell its stock? It's not enough to simply avoid speculative junk. A crash-proof portfolio is actively constructed by identifying and acquiring businesses of extraordinary quality. These are companies with deep, structural advantages that protect them from the relentless onslaught of competition. Warren Buffett calls this a durable competitive advantage, or a moat. Just like a medieval castle was protected by a wide moat filled with water, a great business is protected by a powerful barrier that keeps competitors at bay. Identifying these moats is the core skill of long-term investing and defensive investing. To truly understand this, we must travel back to the fall of 1988, just 1 year after one of the most terrifying market crashes in modern history. On October 19, 1987, known as Black Monday, the Dow Jones Industrial Average plummeted nearly 23% in a single day. Panic was rampant. The prevailing wisdom was that stocks were dangerous, unpredictable, and to be avoided at all costs. But in Omaha, Nebraska, Warren Buffett was not panicking. He was doing his homework. He was meticulously analyzing one of the most well-known companies in the world, the Coca-Cola Company. At the time, many saw Coca-Cola as a boring, mature company. Its stock had gone nowhere for years. But Buffett wasn't looking at the stock chart. He was looking at the business through the lens of the 10-year test. He asked himself, what is the fundamental reality of this business? He saw a company that sold a simple, beloved product that cost very little to produce. He saw a business that was, for all practical purposes, a royalty on global thirst. Every day, billions of people around the world would reach for a beverage. A significant and growing number of them would choose a product owned by Coca-Cola. He traveled the world and saw the brand's power firsthand. Whether in a bustling city in Asia or a small village in South America, the iconic red and white logo was instantly recognizable. This wasn't just a brand, it was a permanent fixture in the human mind. The moat was immense. Could a new startup, let's call it Pepsi-Cola, come along and displace Coke? Well, a company named Pepsi-Cola already existed, and despite a century of effort and billions in advertising, it had failed to unseat Coke as the global king. The brand was an almost insurmountable barrier. Furthermore, Buffett analyzed the company's financial statements. He saw a business that required very little capital to grow. It wasn't like a steel company that had to constantly build expensive new factories. Coke's main assets were the secret formula in a vault in Atlanta and the brand equity in the minds of its customers. This meant it generated enormous amounts of free cash flow, money that could be returned to shareholders through dividends and buybacks. He saw a business that was a financial fortress. While the rest of the world was terrified by the memory of the 1987 crash, Buffett, applying his long-term business owner mindset, saw a wonderful business on sale. Over the course of 1988, Berkshire Hathaway invested over $1 billion to acquire a substantial stake in Coca-Cola. It was one of the largest investments of his career. He was buying with a time horizon of decades, not days. He was buying a 10-year business, and it would become one of the most successful investments in history. The reason most investors fail to identify businesses like Coca-Cola in 1988 is because their judgment is clouded by common cognitive shortcuts. Two of the most powerful are the availability heuristic and salience bias. The availability heuristic is our tendency to overestimate the importance of information that is easily recalled. Whatever is in the news, whatever our friends are talking about, whatever has recently been successful, that is what looms largest in our minds. In the world of investing, this leads people to chase hot trends. In the late 90s, it was dot-com stocks. In 2020, it was profitless tech and electric vehicle startups. These companies were constantly in the headlines, making them available to our minds. Boring, predictable businesses like Coca-Cola or See's Candies rarely make the front page, so they are often ignored, even when their underlying fundamentals are superior. Salience bias is a close cousin. It's our tendency to focus on things that are prominent, flashy, or emotionally striking. A company promising to revolutionize transportation with flying cars is far more salient than a company that makes trash collection routes more efficient. The story is better. It captures the imagination. Speculators are drawn to salience like moths to a flame. They want the exciting narrative, the get-rich-quick story. They mistake a good story for a good investment. The 10-year test is a powerful tool to fight these biases. It forces you to look past the readily available information and the salient story. It compels you to ask deeper, more difficult questions about the long-term durability of the business. Is this exciting new technology truly a sustainable business, or is it a fad? Will this company's product be just as essential in a decade as it is today? The test systematically diverts your attention from the superficial and directs it toward the structural. It is a filter for quality, a machine for finding the boring, unsalient, but incredibly profitable businesses that create lasting wealth. So how do you practically identify these moats? How do you build a checklist for a 10-year business? This is where you move from theory to the nitty-gritty of due diligence. you can use a framework I call the Durable Competitive Advantage Checklist. It boils down to 4 primary types of moats. Before you invest in any company, you must be able to confidently identify at least one of these. First, there is brand power, or what is technically known as an intangible asset. The question to ask is the no substitute test. Would a significant number of customers pay a premium for this company's product, even if a generic and cheaper version were available right next to it? Coca-Cola is the classic example. So is Apple's iPhone or a Louis Vuitton handbag. The brand itself creates value and pricing power. If the brand is the only thing the company has, you must then ask if that brand is likely to be just as powerful in 10 years. Second, there are switching costs. Here you apply the pain-to-leave test. How difficult, expensive, or time-consuming would it be for a customer to switch from this company's product or service to a competitor's? Think about your local bank. Moving all your automatic payments and direct deposits is a massive headache, so you probably stick with them even if another bank offers a slightly better interest rate. Enterprise software companies like Microsoft with its Office suite are masters of this. An entire company trained on Excel and Word is not going to switch to a new system just to save a few dollars. The switching costs are too high. The third moat is the network effect. This is perhaps the most powerful moat of the digital age. The question is the more is better test. Does the value of the service increase for every user as more users join the network? A telephone is useless if only one person has one. It becomes incredibly valuable when everyone has one. Social media platforms like Facebook, marketplaces like eBay, and credit card companies like Visa and American Express all benefit from powerful network effects. The more people who accept Visa, the more valuable it is for consumers to have a Visa card, and the more consumers who have a Visa card, the more essential it is for merchants to accept it. This creates a virtuous cycle that is incredibly difficult for a new competitor to break. Finally, the fourth moat is a cost advantage. This is the cheaper and better test. Can this company produce its product or provide its service at a significantly lower cost than its rivals, allowing it to either have higher profit margins or undercut everyone on price? This can come from economies of scale, like Walmart's massive purchasing power, or from a unique process or geographical advantage. This checklist is your blueprint for financial modeling at a qualitative level. It's not about complex spreadsheets. It's about understanding the core strategic position of a business. Running a potential investment through this gauntlet transforms stock picking from a guessing game into a methodical process of identifying high-quality stocks. The landscape of business history is littered with the corpses of companies that were once great but failed the 10-year test because their moats were not durable. To see the antithesis of this principle, one needs to look no further than companies like Kodak or BlackBerry. In their heyday, both were titans of their industries, seemingly invincible. Kodak dominated the world of photography for a century. It had a powerful brand and a massive distribution network. For generations, a Kodak moment was a cultural touchstone. An investor in the 1980s, looking at its history, might have thought it was a "forever stock." But they would have failed to ask the right question for the 10-year test. What could kill this business? The answer, of course, was the digital camera, a technology that Kodak itself invented but was hesitant to embrace for fear of cannibalizing its lucrative film business. Its moat, based on chemical film processing, was susceptible to technological disruption. It wasn't a durable moat. Similarly, Research in Motion, the maker of the BlackBerry, was the king of the smartphone market in the mid-2000s. It had high switching costs for its corporate clients with its secure email servers and a network effect among users of BlackBerry Messenger. It seemed unassailable, but its moat was built on the idea of a physical keyboard and email-centric functionality. When Apple introduced the iPhone in 2007, it redefined the entire market around a full touchscreen interface and a universe of applications. BlackBerry's moat was revealed to be a shallow ditch, easily crossed by a superior technology and a better business model. People who owned these stocks and simply hoped for a return to the good old days were wiped out, They mistook past success for a guarantee of future durability. They were focused on the company's history, not its ability to withstand the next decade of change. The presence of a durable competitive moat is not just a theoretical concept, it leaves a clear and unmistakable footprint on a company's financial statements. This is the direct financial connection. When you look at the balance sheet and income statement of a company with a strong moat, you will see specific quantitative evidence of its quality. First, look for consistently high profit margins and return on equity. A business that is constantly battling with competitors in a price war will have razor-thin margins. A business protected by a moat, like Coca-Cola or See's Candies, can price its products based on the value they provide, not the cost of production. This leads to fat, juicy profits year after year. A high return on equity without using a lot of debt is a clear sign that the company has a special advantage. Second, look for a history of stable and predictable revenue growth. A commoditized business is subject to wild swings in its fortunes based on the economic cycle. A business with a moat often sells a product or service that is essential or deeply desired, leading to a much smoother and more predictable stream of income. This predictability is invaluable when you're trying to project a company's earnings power over a decade. Finally, and perhaps most importantly, look for strong and growing free cash flow. This is the cash the business generates after all its expenses and necessary reinvestments in the business are paid for. Companies with moats, especially those like See's Candies that don't require massive capital expenditures to grow, become veritable cash machines. This free cash flow is the lifeblood of shareholder returns. It can be used to pay dividends, buy back stock, which increases your ownership stake, or be reinvested in other profitable ventures. A business that does not consistently generate free cash flow is not a fortress. It's a sandcastle waiting for the tide to come in. The 10-year test forces you to become a financial detective, searching for these quantitative clues. It transforms the intimidating wall of numbers in an annual report into a story about the company's true underlying strength and durability, providing the foundation for true wealth preservation. Even if you understand the difference between an investor and a speculator, and even if you know how to identify a 10-year business, there is still a final, formidable enemy you must defeat: yourself. The greatest challenge in long-term investing is not intellectual, it is emotional. It is the battle fought within your own mind against the tyranny of the ticker, the constant, flashing stream of prices that can hijack your rational brain and trigger your most primal instincts of fear and greed. Mastering this emotional game is the final key to building a crash-proof portfolio, and the 10-year test is your most powerful weapon. There is no greater crucible for this emotional battle than a full-blown market panic. And there is no greater panic in recent memory than the global financial crisis of 2008. In the autumn of that year, the global financial system was on the brink of collapse. Lehman Brothers, a 158-year-old investment bank, had declared bankruptcy. AIG, the world's largest insurance company, had been bailed out by the government. Banks stopped lending to each other. Credit markets froze. The stock market was in a state of freefall, plummeting day after day. The news headlines were apocalyptic. The atmosphere was one of pure, unadulterated terror. For the average person watching their 401k evaporate, the instinct was singular and overwhelming. Sell everything. Get out of the market at any cost. But in the midst of this chaos, on October 16, 2008, Warren Buffett published an op-ed in the New York Times. The title was, "Buy American I Am." The article was a masterclass in emotional control and long-term thinking. While everyone else was staring in horror at the collapsing stock prices, Buffett was applying the 10-year test on a grand scale. He wrote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful." He wasn't looking at the ticker, he was looking at the underlying businesses of America. He asked himself, will the great companies of this country, the innovators, the manufacturers, the service providers, be earning more money 10 years from now? His answer was an unequivocal yes. He saw the panic not as a reason to sell, but as an extraordinary opportunity to buy. The fear in the market had created a once-in-a-generation sale on wonderful businesses. He wasn't just talking, he was acting. He invested billions of dollars into iconic American institutions like Goldman Sachs and General Electric when their very survival seemed in question. He was able to do this because his mental framework was not tied to the market's daily mood swings. His investment decisions were anchored to his assessment of long-term business value. He had already decided he was an owner for the next decade. The fact that the market was offering him a chance to increase his ownership at bargain prices was a gift, not a curse. The 2008 crisis was the ultimate test of his philosophy, and because he had internalized the market is closed mental model, he passed it with flying colors, generating billions in profits for Berkshire Hathaway and providing a powerful lesson for all investors on the importance of psychological fortitude. Buffett's calm during the storm is admirable, but for most people it feels superhuman. That's because during a market crash, our brains are hijacked by two of the most powerful forces in behavioral psychology: herd behavior and loss aversion. Herd behavior, also known as social proof, is our deep-seated instinct to follow the crowd. For millennia, this was a brilliant survival strategy. If everyone in your tribe suddenly started running, you didn't stop to ask why. You ran too. It was better to be safe with the herd than to be eaten by a lion alone. In financial markets, however, this instinct is catastrophic. When the market crashes, the social proof is deafening. Everyone is selling. Your friends are selling. The experts on TV are screaming, "Sell." The herd is stampeding for the exits, and every fiber of your being tells you to join them. Resisting this pull feels physically unnatural. Compounding this is the intense pain of loss aversion we discussed earlier. Watching your portfolio value drop 10%, 20%, 30% is not a pleasant intellectual exercise. It is a visceral, gut-wrenching experience. Your brain interprets this financial loss as a genuine threat to your survival and well-being. It screams at you to make the pain stop, and the only way to make it stop is to hit the sell button. This combination of herd instinct and loss aversion creates a toxic psychological cocktail that compels the average investor to do the exact wrong thing at the exact wrong time. Sell low, in a panic. The 10-year test acts as a pre-commitment device, a psychological anchor you set in calm waters before the storm hits. By consciously deciding before you buy that you are prepared to hold a business for a decade, you are giving your future panicked self a direct order. You are telling yourself, the daily price doesn't matter. The herd's opinion doesn't matter. I made a rational decision to own this business for the long term, and I will not be swayed by short-term fear. It is a declaration of independence from the emotional whims of the market. You can actively train this psychological muscle with a powerful technique, the market shutdown visualization exercise. This is a mental simulation that you must run before you make any significant investment. It's a crucial part of any robust risk management framework. Step 1. Sit down in a quiet room. Close your eyes. Take the stock you are considering buying and visualize yourself executing the purchase on your computer. Now imagine a pop-up window appears on the screen. It reads, "System alert. All global stock markets will be closed for the next 10 years. Your account is now locked. All transactions are suspended." Feel that. Imagine the finality of it. You cannot sell. You cannot change your mind. You are married to this investment for a full decade. Step 2. Now, with your account locked, begin to visualize the worst-case scenarios for the world over those 10 years. Imagine a deep and prolonged recession. Imagine your own industry is disrupted and you lose your job. Imagine a global pandemic that shuts down travel and commerce. Imagine a period of high inflation that erodes purchasing power. Don't shy away from these dark thoughts. Confront them head-on. Step 3 is the moment of truth. With these nightmare scenarios playing in your mind, turn your attention to the specific business you just bought. How does it fare? Does it sell an essential product that people will need even in a deep recession? Does it have a fortress balance sheet with little debt, allowing it to survive a credit crisis? Does it have the pricing power to pass on rising costs during an inflationary period? As you run through this simulation, pay attention to your physical reaction. Do you feel a rising sense of panic, a knot of dread in your stomach? That is your subconscious mind telling you that this business is not resilient enough. You have failed the test. But if, as you imagine the chaos, you feel a sense of calm confidence in the durability of your chosen business, if you genuinely believe it will emerge from the storm stronger than ever, then you have passed. You have found a true 10-year business, and you can invest with genuine peace of mind. To understand the immense value of this psychological training, we need only look at the behavior of the average retail investor during the most recent market panic, the COVID-19 crash of March 2020. As the world shut down, the stock market went into a historic nosedive. The VIX, the market's fear gauge, spiked to levels not seen since the 2008 crisis. The narrative was one of unprecedented uncertainty. For weeks, the market fell by thousands of points a day. The herd was stampeding. And what did the average investor do? They followed the herd. Brokerage data shows that retail investors sold stocks at a record pace during the market bottom in late March. They capitulated. They let the intense pain of loss aversion and the overwhelming social proof of the herd dictate their actions. They sold their shares in wonderful durable businesses like Apple and Microsoft and Visa at fire sale prices, locking in devastating losses. And then, what happened? The market, fueled by government stimulus and the realization that many of these great businesses were actually benefiting from the stay-at-home economy, staged one of the fastest and most ferocious recoveries in history. The very people who sold in a panic at the bottom were then faced with the agonizing decision of when to get back in, often buying back the same stocks they had sold, but at much higher prices. They sold low and bought high, the cardinal sin of investing. They were slaves to the tyranny of the ticker, and they paid a terrible price. They were playing the speculator's game, reacting to fear, while the investor who had applied the 10-year test was either calmly holding on or, like Buffett, actively buying more. The direct financial consequence of this emotional discipline, or lack thereof, can be quantified by a concept called volatility drag, or more simply, the cost of panic. This is a mathematical reality that decimates the returns of those who try to time the market. Studies by Dalbar and other financial research firms consistently show that the average investor's returns are significantly lower than the market index returns over the long term. Why? Because they panic sell during downturns and greedily buy in after the market has already run up. A crucial and often misunderstood fact is that the market's best days often happen in close proximity to its worst days, usually during periods of high volatility. By selling out during a crash, you not only lock in your losses, but you also make it highly likely that you will miss the powerful rebound days that are essential for long-term growth. Missing just the 10 best days of the market over a 20-year period can cut your total returns in half. The 10-year test is the ultimate tool for avoiding this catastrophic behavior. It's a simple, elegant piece of mental software that prevents the single worst financial decision you can make. By forcing you to adopt the mindset of a long-term business owner, it makes selling in a panic almost unthinkable. Why would you sell your share of a wonderful, profitable business just because a bunch of scared strangers on Wall Street are having a bad month? It's an irrational proposition. By eliminating this self-inflicted wound from your investment strategy, you ensure that you capture the full, long-term return of the quality businesses you own. You transform volatility from a source of terror into a potential opportunity, creating a portfolio that is not just financially sound but psychologically sound as well. We have established the mindset of an owner, the anatomy of a fortress-like business, and the psychological discipline to weather any storm. Now we must translate this philosophy into a concrete, repeatable process. How does an individual investor with limited time and resources actually go about building a portfolio of these 10-year businesses? This is where the rubber meets the road. It requires a commitment to a methodical process of due diligence and valuation, a process that separates professional-grade investing from amateur speculation. The journey from a good idea to a great investment is paved with rigorous work. For a masterclass in this kind of deep, investigative work, we can look to one of Warren Buffett's earliest and most brilliant investments, the Washington Post Company. In 1973, the stock market was in a funk. The Nifty 50 growth stocks had crashed, and the general sentiment was bearish. The Washington Post, despite its recent journalistic triumphs with the Pentagon Papers and Watergate, saw its stock price pummeled along with the rest of the market. Its market capitalization fell to around $80 million. Buffett, however, saw something that the market was missing. He didn't just look at the stock price. He began an intense process of due diligence, applying the principles of a business owner. He calculated that the entire company was being valued at a price that was less than the value of its individual, sellable assets. The company owned the newspaper, Newsweek magazine, several television stations, and other properties. Buffett conservatively estimated that these assets, if sold off individually, would fetch between $400 and $500 million. The market was offering him a chance to buy a dollar for 20 cents. This was the classic Ben Graham margin of safety. But Buffett went deeper. He wasn't just buying a collection of assets. He was buying a business with a powerful, durable, competitive advantage. He recognized that in the 1970s, a major city's dominant newspaper was a natural monopoly. It was the essential source of local news, classified ads, and retail advertising. A competitor would have to spend an exorbitant amount of money to replicate its printing presses, its distribution network, and most importantly, its brand recognition and reader loyalty. The Washington Post had a deep moat around its core business. He didn't just analyze this from his desk in Omaha. He did the scuttlebutt. He talked to people in the industry. He built a mental model of the media business from the ground up, understanding its economics and competitive dynamics. He was performing a private equity-style analysis on a publicly traded stock. When he invested more than $10 million to become one of the Post's largest shareholders, he wasn't gambling on a stock price. He was making a calculated, deeply researched decision to buy a fantastic business at a ridiculously cheap price. He was so confident in his analysis that he would have been delighted if the market had closed for the next 10 years, allowing the company's intrinsic value to grow unimpeded by the market's manic depressive mood swings. This investment would ultimately multiply in value more than 100 times over for Berkshire Hathaway. The kind of deep work Buffett did on the Washington Post stands in stark contrast to the shallow analysis that plagues most investors, a flaw driven by two insidious biases: confirmation bias and overconfidence bias. Confirmation bias is our natural tendency to seek out and favor information that confirms our existing beliefs, and to ignore or discount information that contradicts them. Once we get an idea in our head that a certain stock is a winner, we start seeing it everywhere. We click on the positive news articles, we listen to the bullish analysts, and we dismiss the naysayers as dinosaurs who just don't get it. We build a comfortable echo chamber around our decision, protecting it from any inconvenient facts. Overconfidence bias is the belief that our own skill and judgment are better than they actually are. It leads us to believe that we can predict the future, that we've found the next big thing, and that we don't need to do the boring, tedious work of reading financial statements or analyzing competitive landscapes. We fall in love with a story, a charismatic CEO, or a revolutionary technology, and our overconfidence blinds us to the potential risks. The 10-year test is a powerful antidote to these biases. It forces an adversarial approach to due diligence. By asking, "Would I be happy if the market closed for a decade?" you are compelled to actively search for reasons why the answer might be no. You have to ask the tough questions. What could disrupt this industry? What is the strongest argument against this investment? Who are the smartest competitors? And what are they doing? It shifts your mindset from one of seeking confirmation to one of actively seeking disconfirmation. This intellectual humility is a hallmark of all great investors. It forces you to do the work, to kick the tires, and to ensure that the foundation of your investment is solid rock, not shifting sand. This leads us to the practical blueprint for portfolio construction, the 10-year fortress method. This is a 5-step investment strategy for the retail investor who wants to build a portfolio that can last a lifetime. Step 1 is idea generation. Look for businesses within your circle of competence. What industries do you understand from your own work or hobbies? Start there. Make a list of public companies that you interact with and admire as a consumer. This is your initial hunting ground. Step 2 is the initial filter, the 10-year test. For each company on your list, run the market shutdown visualization exercise. If you feel any sense of dread or panic, cross it off the list immediately. This first pass will likely eliminate 80 to 90% of your initial ideas, saving you a huge amount of time. It instantly filters out the speculative and the fragile. Step 3 is the due diligence gauntlet. For the handful of companies that remain, you must do the real work. Run them through the durable competitive advantage checklist. Can you clearly identify a powerful brand, high switching costs, a network effect, or a significant cost advantage? Read the last 5 years of their annual reports, paying special attention to the letter to shareholders. Understand how they make money and what the key risks are to their business model. Step 4 is valuation. A wonderful business is not a wonderful investment if you overpay for it. You don't need a complex financial model. You can use simple metrics like the price-to-earnings ratio or price-to-free cash flow ratio and compare them to the company's own history and its competitors. The goal is not to find the exact intrinsic value, but to ensure you are buying with a, quote, margin of safety. You want to buy a great business at a price that is fair, or ideally, cheap. Step 5 is diversification and position sizing. You should aim to build a portfolio of between 5 and 15 of these 10-year fortress businesses, spread across different industries. Don't bet your entire life savings on a single company, no matter how great you think it is. By building a concentrated portfolio of your best, most well-researched ideas, you achieve a balance between the risk-reducing benefits of diversification and the return-enhancing power of concentration. The antithesis of this careful, methodical process was on full display during the mania surrounding the ARK Innovation ETF in 2020 and 2021. ARK, managed by Cathie Wood, invested in a concentrated portfolio of what it called disruptive innovation stocks. These were companies with compelling stories about changing the world in fields like genomics, robotics, and artificial intelligence. The narrative was incredibly powerful and salient, and as the fund's performance went parabolic, a flood of retail investors piled in, driven by a combination of greed and fear of missing out. However, many of these investors skipped the crucial steps of the fortress-building process. They did not perform their own due diligence on the underlying companies. Many of the fund's top holdings were deeply unprofitable, burning through cash with no clear path to sustainable earnings. They were story stocks, not proven businesses. Investors also completely ignored valuation. They were paying nosebleed prices for these companies, prices that discounted decades of perfect execution. There was no margin of safety. When market sentiment shifted in late 2021 and 2022, and investors began to favor profitability over promises, the fund and its underlying stocks crashed spectacularly, with many falling 70 to 80% or more from their peaks. People who had poured their savings into the fund at the top of the bubble were financially devastated. They had outsourced their thinking, fallen in love with a narrative, and ignored the timeless principles of buying quality businesses at reasonable prices. They failed to apply the 10-year test, and as a result, their portfolios were built not as fortresses, but as houses of cards. The direct financial connection here is the concept of margin of safety, perhaps the most important 3 words in investing. Buying a high-quality business, identified through the 10-year test and the due diligence gauntlet, at a price significantly below your conservative estimate of its intrinsic value is what creates this buffer. The margin of safety is what protects you when you make a mistake, when bad luck strikes, or when the economy takes an unexpected turn for the worse. It's the shock absorber for your portfolio. A portfolio constructed using the 10-year fortress method will have fundamentally different financial characteristics than a speculative one. It will likely have a lower beta, meaning it will be less volatile than the overall market. It will exhibit a superior Sharpe ratio, which is a measure of risk-adjusted return. Over the long run, it will not only produce substantial returns, but will do so with a much smoother ride, allowing you to sleep soundly at night. The margin of safety is the structural engineering that turns a collection of stocks into a fortress. It is the tangible financial advantage that comes from a disciplined business-like approach to investing. It ensures that your path to financial security is built on a foundation of value and resilience, capable of withstanding any storm the market throws at it. We have arrived at the final and perhaps most profound pillar of this philosophy. After all the work of developing the right mindset, identifying the right businesses, mastering your emotions, and building your fortress portfolio, what comes next? The answer is both deceptively simple and extraordinarily difficult. You let the compounding engine run. You recognize that true wealth preservation is not a defensive crouch, but the most powerful offensive strategy imaginable. By avoiding the catastrophic losses that plague speculators and market timers, you allow the eighth wonder of the world, compound interest, to work its uninterrupted magic. This final stage requires a level of patience and discipline that few possess, but it is the ultimate payoff for adopting the 10-year test. To see this principle in action, we turn to the story of Warren Buffett's investment in American Express during the salad oil scandal of 1963. It's a tale that demonstrates how a long-term perspective can turn a moment of crisis into a lifetime of wealth. A New Jersey company had secured huge loans from American Express's warehousing subsidiary, using barrels of salad oil as collateral. The problem was, the barrels were mostly filled with seawater, with only a thin layer of oil on top. When the fraud was discovered, the company went bankrupt, and American Express was on the hook for massive losses. The market panicked. Wall Street assumed that American Express would be ruined, that the scandal would destroy its reputation and its core businesses. The stock price was decimated, falling by nearly 50%. The herd was stampeding for the exit. But a young Warren Buffett, then running his small investment partnership, decided to do his own due diligence. He applied the 10-year test. He asked, has this temporary business problem permanently damaged the company's long-term competitive advantages? He knew that American Express had two main engines, its travelers' checks and its credit card business. So he went out into the real world to investigate. He visited restaurants and hotels, talking to cashiers and managers. He asked them, "Are you still accepting American Express cards?" They all said yes. Customers were still using them. He went to banks and observed their operations. He asked if they were still selling travelers' checks. They were. He realized that the fundamental business, the powerful brand and network effect that lived in the minds of consumers and merchants, was completely unharmed by the scandal at the warehousing division. The market was confusing a temporary, albeit large, loss in one small part of the business with a fatal blow to the entire enterprise. He saw a $10 bill on the ground, and Wall Street was screaming that it was worthless. Convinced of his analysis, Buffett invested 40% of his partnership's entire capital into American Express stock. It was an incredibly bold, concentrated bet. He would have been overjoyed if the market had closed for the next decade. Within a few years, the stock had multiplied in value 5 times over, making a fortune for his partners and cementing his reputation as a brilliant investor. The key was his ability to look past the terrifying headlines and focus on the enduring reality of the business itself, the very essence of our mental model. The ability to hold on through thick and thin, as Buffett did with American Express, is bolstered by a positive application of a psychological principle called the endowment effect. Typically, the endowment effect is seen as a negative bias. It's our tendency to overvalue something simply because we own it. It's why we have trouble decluttering our homes, and why we often hold on to losing investments for too long, hoping they'll come back. But when you have built a portfolio using the rigorous filter of the 10-year test, the endowment effect can be transformed into a superpower. You are not just holding on to a random collection of stocks. You have painstakingly selected each company. You have done the due diligence. You have written the investment memo. You have confirmed its durable competitive advantage. You feel a genuine sense of ownership. This creates a healthy and rational attachment. You value your stake in this wonderful business more than the market's fleeting daily opinion of it. This positive endowment makes you far less likely to be shaken out during a market panic. While others are selling their generic stocks, you are holding on to your share of Coca-Cola or your piece of Apple. This mindset shift is subtle but incredibly powerful. It helps you overcome the temptation to meddle, to trade, to react. It anchors you to your long-term plan and allows you to become a true partner with the great businesses you own. This leads to the final blueprint, the ultimate application of our mental model, the do-nothing protocol. After you've built your fortress portfolio, the most financially productive action you can take is, most of the time, nothing at all. This is the zen of long-term investing. Here is the protocol. Step 1. Schedule a portfolio review just once or twice a year. Delete the brokerage app from your phone's home screen. Stop watching financial news. Your job is not to be a market commentator. Your job is to be a business owner. Constant monitoring only invites fear, greed, and the temptation to act. Step 2. During your scheduled review, your only task is to re-ask the 10-year test for each of your holdings. Has the fundamental business changed? Is its durable competitive advantage still intact? Has a new technology or competitor emerged that genuinely threatens its long-term future? Step 3. You are only permitted to sell a stock if the answer to that question is a clear and unambiguous no. You sell the business, not the stock. You do not sell because the price went up and you want to lock in a gain. You do not sell because the price went down and you are scared. You hold on, patiently, unless the fundamental reason you bought the business in the first place is no longer valid. This discipline is the final key that unlocks the full power of compounding. It is the hardest step because it goes against our innate desire to be constantly doing something. But in investing, activity is often the enemy of returns. The antithesis of this patient protocol is the modern-day trader. Fueled by zero-commission apps and the gamification of the stock market, the day trader lives in a world of constant motion. Their screens are filled with flashing charts and endless streams of data. They are trying to scalp pennies and dollars from the market's random, short-term movements. They mistake this frenetic activity for progress. But what is the reality for the vast majority of these traders? They are being eaten alive by hidden costs. The bid-ask spread on every trade is a small tax paid to the market makers. Their short-term gains are taxed at the highest possible rates. But most importantly, they are operating in a state of high-stress, cortisol-fueled anxiety. They are slaves to the ticker, their emotions rising and falling with every tick of the market. Their portfolio is a leaking bucket. They can never benefit from the long, slow, powerful magic of compounding because they never hold on to a great business long enough for it to work. They are perpetually planting seeds and then digging them up the next day to see if they've grown. The result is almost always the same: high stress, high effort, and low returns. They are playing a game that is rigged against them, while the patient, long-term owner is playing a game that is almost impossible to lose over time. The direct financial connection, the ultimate prize for mastering this entire philosophy, is the explosive power of uninterrupted compound growth. Imagine 3 investors, each starting with $10,000. Investor A is the speculator. They chase hot stocks, experience huge gains and devastating crashes. Their returns are volatile, and after 30 years, they have managed to turn their $10,000 into $50,000, having endured a stomach-churning ride. Investor B is the market timer. They try to be clever, selling when they think the market is high and buying when they think it's low. But they are inevitably wrong, missing the market's best days while sitting in cash. After 30 years, their $10,000 has grown to $150,000, better than the speculator, but far from its potential. Now consider Investor C, the 10-year test investor. They use the principles we've discussed to build a portfolio of high-quality, durable businesses. Their returns are not as spectacular in any single year as the speculator's best year, but they are steady and consistent. They avoid the big crashes. They simply hold on, letting their great businesses do what they do best: grow and generate profits. After 30 years, their $10,000, compounding uninterrupted, has grown to over $500,000, perhaps even $1 million. The difference in the early years is small, almost unnoticeable, but in the final decade, the compounding curve becomes nearly vertical. This is the final promise. The 10-year test is not just a tool for risk management or defensive investing. It is the single most effective offensive weapon for building life-changing wealth. It is the mechanism that ensures your money works for you, relentlessly, day and night, for decades, building a future of financial security and freedom that the speculator can only dream of. You have just spent this time acquiring a powerful piece of mental machinery. The 10-year test is not just an idea, it is a filter. It is a lens that, once you learn to look through it, permanently changes how you see the world of investing. It is the mechanism that separates the signal of true business value from the deafening noise of market speculation. You now possess the foundational tool to build a fortress around your capital, one that can protect you from the emotional storms of the market and the costly mistakes they induce. But a fortress, no matter how strong, is only as valuable as the treasures it protects. You have now mastered the art of building the walls. The next step is to master the art of finding the treasure to put inside. The 10-year test is the gatekeeper, the final question you ask before letting a company into your portfolio. But Buffett's complete system is a network of interconnected mental models, a comprehensive map for identifying the world's most exceptional businesses in the first place. You have just acquired one crucial piece of that map. And as you look at the screen, you'll see another video. Think of that video not just as another piece of content, but as the next piece of that map. It is the link that connects what you've just learned to the next level of understanding. It holds the key to the frameworks and checklists that proactively seek out the kind of quality businesses that can actually pass the demanding 10-year test. What you have learned today is how to defend. That video is how you go on the attack. The question now becomes one of identity. Are you simply a passive viewer, collecting bits of information? Or are you an active architect, committed to building your complete mental arsenal for financial independence? For those who are serious about this journey, the choice is clear. The click you are about to make is not just a click, it is a declaration. It is your commitment to continue the ascent, to acquire the next tool, and to complete the construction of your financial future. Continue the journey,